Required part, as a finance manager of this company, prepare a memo. Yeah, prepare a memo to the MD that includes evaluation of the impact of the proposed financing options to companies' earnings per share. So we will need to see in our case study what are these financing options, then we advise accordingly. Remember, a memo, you must be having, how do we start? To, from, date, and the subject. That is a memo. So we need to read through our case study and see what are the financing options given. They are telling us that NML is a listed company. Remember, as long as you are a listed company on the security or stock exchange market, you need to apply actually this standard as a must. Okay, this is a listed company with issued and fully paid up share capital of shillings 12,500 million. That is our share capital. Okay. These companies' share are quoted at shillings. This is our quoted at shillings. This amount of money per share representing a 50% premium above their par value. So if they say it is quoted at shillings, this 1,500, it means that ideally this is your market price, okay? Representing 50% premium above their par value. So you don't know the par value, but this 1,500 represents 50% premium, which is above the par value. So it means that you can actually rely on this to get your par value. A review of the company's most recent financial statements revealed that the company reported taxable profits. You will need this. This is your tax. And when they say taxable profit, that is the profit which is not yet taxed. And as we deal with earnings per share, you realize that actually we needed to focus on our profit after tax. So it means that whenever you're given taxable profit, you need to convert and get your profit after tax. So that is your profit before tax for the year ended 30th June 2023, representing a marginal improvement in its earnings performance compared to the previous year. Okay, the reported profit is expected to remain constant for the following 2 years. Okay, NML pays corporation tax at this in areas. Since incorporation, the company has maintained a robust growth in its financial performance and position, and wishes to expand its operations by opening up regional branches. Across the country. Okay, in order to achieve the proposed expansion, NML is considering issuing what we call debt instruments, okay, to raise the required funds. So these are now they are telling you some financing options. Consequently, the finance manager of the company has proposed the following financing options. Okay, for consideration by the committee. One, the company issues 1 million 15% convertible debentures of shillings 2,000 each, which are convertible into 2 equity shares of shillings 1,000 each in 2 years from the date of issue at the option of the holder. Now, every time you see such a kind of debt, which is going to be converted in the future into equity, you need to think about some things. You need to think about some things. You're converting debt, this is convertible debt to equity. What are the things that are going to be affected? Mhm. Remember, we said that every time you see that you're converting a debt to equity, then you're not talking about basic earnings per share, but instead, this time you will be looking at the dilution, or what we call diluted EPS. You will not be looking for basic EPS, but instead you'll be looking at what? At diluted EPS. And there are some things that you need now, because we have the formula as we are going to see. So the first option is the convertible debentures into equity. That is first option. Then the next option, the company issues a 1.6 million debenture stocks, where each debenture has one warrant attached, giving the right to the holder to buy one ordinary share at a price of shilling 1,250, and the market price at exercise date is likely. Now, this is warrant option, or what we call share option. And in such scenario where you're dealing with warrant option or share option, also ideally you will be looking at the diluted EPS. You need to know in what scenario can you actually be dealing with basic EPS, and in which scenario can you be dealing with diluted EPS.
Abel, so that's not a right.
Pardon?
That's not a rights issue.
This is not a rights issue. Yes. If it is a rights issue, then you will be talking about, actually, you will be looking for basic EPS. But if it is share option, share option is the same as warrant, where you're going to see that actually share option is not the same as rights issue. They are different. They are different. But rights issue, there you are computing basic EPS. Then share option, you're computing diluted EPS. But let's do this practically. You'll understand the difference as we move forward, as we do other parts. Let's first hand option 1 and see how can you actually get diluted EPS. Option 1. And with option 1, here we are looking at basically convertible. We are looking at convertible debenture. Debenture. Let me work this spelling debenture. Okay, that is option 1, where you're converting this debt to equity. How can you handle? Recall what we are interested in. We are interested in diluted EPS. And the formula is so this is profit after tax, then minus the preference dividend, then minus the profit you're going to profit to NCI. Let me hope you recall that. Basically, when you see the word earnings, we are talking about this as we are determining our EPS. Basically, you need the profit after tax, then less preference dividend, less if you have a profit that you paid it that is contributed to NIC, that is non-controlling interest, then you subtract it. This one, you're adding it because you're converting a debt to equity. And in such scenario, you realize that you will be actually you will actually save some interest. Remember, whenever there is a debt, you are supposed to pay interest. But the fact that you're converting that debt into equity, and when you have equity, you're not paying interest, it means that at the end of it all, you're going to save some interest. But the fact that you're saving interest, you're losing out also on the tax benefit. So that's why we are calling it net interest. To get the interest you are supposed to pay, then we raise the tax benefit such that we can get our net interest. So that's how, and you add it because you're converting a debt to equity. So you need to know which option are you dealing with. The formula will not remain constant. No, it depends on the option, the financing option you're dealing with. Here we are adding net interest saved because you're converting a debt to equity. Then here we are getting existing shares plus shares on conversion because you'll be converting debt into equity, and in such scenario, there are some shares that are going to be included. So we start with profit after tax. Basing on the question, are we given profit after tax? We have taxable what? We have taxable profits as 4,400 million. So that is taxable profit, but I need profit after tax. So how are you going to get profit after tax? You can just get that for 4,400 million. Then you simply multiply by 70%. There you will get your profit after tax. How much is this? Those with the calculator. Or another person can say, I have profit before tax, which is equal to 4,400 million. Then I erase tax, which is 30%. 30% of your profit before tax. You will get the same answer.
I'm getting 3 million thousand.
The profit after tax is 3 million, eh? 3 million. Only
80,000. 80. 80,000.
80. Like this, eh? Okay.
Actually, I did add those 3 years. I did add those other 3 zeros.
Okay. Let me hope it is like this, eh?
It is like that.
Okay, so that is our profit after tax. One person can first get profit before tax, then less the tax, which is 30%. You'll still get the same, but this is wasting time in an exam. Eh? So here you will be having 1.32. And if you subtract, I think you get the same. So that is your profit after tax. So we have now the first part. So that is our profit after tax. Basing on our formula, what else do we need? We need preference dividend. But do we have any information talking about preference shares? Because you can only get preference dividend when you have are preference shares. And in this question, we actually don't have preference shares. So where you have preference dividend, it is 0. And you don't have any information talking about profit to NCI. So also where you have profit to NCI, it is 0. So the next thing you need is net interest saved. How are you going to get this net interest? How are you going to get net interest? Net interest. Net interest. Okay. How much are you supposed to pay as interest? Okay. So for you to know how much you're supposed to pay as interest, you first know what is the total loan, what is the amount of loan. So the loan we are talking about here is convertible debenture. Convertible debenture. So what is the total amount of convertible debenture? So we go back to the question, and they are telling us that the company issues 1 million at 15% convertible debenture of shillings 2,000 each. So it means that if you need the overall amount, the number of debenture is 1 million. But what is the total amount of this loan? You get this 1 million times 2,000. Okay. So that will be your loan. And it means that, based on this question, it means that the interest on the debenture is 15%. So what we are going to do is to get the total debenture, which is 1 million. 1 million, then we multiply by 2,000. And this will be our shillings. We can keep this one, we call it this one million. Okay. So that is our amount or our loan. So the question is, what is your interest on this debenture? Interest on debenture. Interest is 15%. You're supposed to pay 15%. So we get 15% times the loan, which is 2,000 million. And how much do you get?
300.
We get 300. Okay. This is the interest you are supposed to pay. You are going to save this interest. But remember, as you save this interest, there is a tax benefit you're losing out. So it means that to get your net interest saved, you will get this interest that you are supposed to pay. Then you less the tax benefit. So what is the tax benefit? Here we less our tax benefit. Remember the tax here, the tax will be 30% times the interest. 30% times the interest, because that's what you're losing out. And what do you get? 30% times 300. You get 90?
It's 90.
90. So finally, what is your net interest saved? The net interest saved, you get your interest on a debenture minus tax benefit.
210.
Which is 210 million. as simple as that. That is your net interest saved. So next, basing on our formula, what do we have existing shares? In the question, do we know the existing shares? Now the next part is to look for existing shares.
Is it that 12,500?
Let me first go back and see existing shares. Now for you are saying what?
Is it that 12,500 million?
This is share capital.
Oh,
Let me see. Wait, let me see. With issued and fully paid share capital of shillings. This is. Do you agree that this is the number of shares really? This is amount. This is not share. This is share
yes,
capital.
exactly. Shillings, yeah. Yeah.
This is share capital. Unless if I copy the wrong thing. So we need. How do you get the number of? How do we get the number of shares? We get the share capital divided by the par value.
Is 1,500. The par value is 1,500.
Are you sure that the par value is one? Are you sure that the par value is this? This is the quoted. This is the quoted price, which is market price. This is not the par. This is not the par value. So how do we par value? They are saying that this market value represents 50% premium above their what? Above their par value. So if I told you you were to compute, if you say from market price, which is equal to the par value, I can just get 1.5 times the par value. Let me hope this one makes sense to you. Or another person can say, to get the market price, since it is a premium, you get the par value, then add 50% of par value, because they are saying 50% premium. So this is your premium. This is your premium. So to get the market price, it is the original par value plus like a premium of 50%. So you will still get this. So you're looking for par value. So let Y be the par value. Let me hope colleagues you're following. I'm not doing this alone. We should move together. So the par value, our market price in the question is how much? Our market price in the question is 1,500. Okay. Ah, 1,500 is equal to 1.5 Y here. So I need Y. Y will be equal to 1,500 divided by 1.5. And what is your par value?
1,000.
It's 1,000. Perfect. This is shillings, 1,000 per share. So since you know the par value, you're going also to say from okay, what will be number of shares? Number of shares, number of shares, number of existing shares will be equal to your share capital.
Capital over the par value.
Your share capital divided by par value, which is equal to what is our share capital?
Oh, it was
12.5 million. Then I divide by 1,000. What do you get?
12.5.
You get 12.5. 12.5. Let's
I
use
didn't put the other zeros. I didn't put.
use our calculator very well. So it is
12.
12,500. 12,500.
Divided by 1,000. It is 12,500.
12,500. Any question at this point? So these are our number of existing. These are our number of existing shares. Okay.
One has to really be sober.
Pardon?
One has to really be sober.
Yes, yes. So the next, we need shares on conversion. We need shares on conversion. That is our next step. How can we get shares on conversion? Or if you convert, if you convert your debt to equity, what will be the number of shares at that time? On conversion. Okay, so how can we get this? It is also not hard. Basically, you need to know that as you convert, as you get the number of shares on conversion, you need to get shares on conversion will be equal to the number of you first need to know what is the number of convertible debentures. What is the total number of debenture? Here you are not talking about the amount, but you're talking about the number of debenture. Then remember, each debenture you are holding as a shareholder, you will receive how many shares if you convert.
Abel, someone needs you.
Yes, go ahead.
I'm concerned with the shares we've got. I have 12,500.
12.5.
Because they gave us the capital shares at 12,500 million. So.
Let me see in the question. Let me see in the question. Yes. I think we are missing out other. So here you are supposed to add other 3 zeros. Thank you. Are you now okay?
Yeah, I'm fine.
Okay. So to get shares on conversion, we are going to get a number of debenture times. If you're holding one debenture, how many shares are you going to receive? You now at the time of conversion, they are telling us that the company issues this, which are convertible into, are you seeing this? Which are convertible into 2 equity shares. 2 equity shares. So here, if you're holding one debenture, you will be in a position to receive 2 shares. If you're converting from debt to equity, it means that every one debenture you're holding, you will be entitled to receive 2 shares. That is the meaning. Okay. So here you multiply by 2 shares. So the question is, what is your number of debenture? What is your number of, but number of debenture is equal to your total amount of debenture. Here you are talking about the amount, total amount, or total loan. Altogether, total loan, because debenture is like a loan. Total amount of debenture, then divided by the par value. This is the par value you're talking about. Here is the par value for the debenture, and they have given us the par value of the debenture. We have the total amount of debenture somewhere, isn't it? Which is 2,000 million. So if you get 2,000 million, divided by the par value is what? In the question, the par value is 1,000 here. Okay. So you will be in a position to get how many debentures? The number 2 million. These are debentures. So therefore, your shares on conversion will be equal to 2 million. 2 million times 2, which is equal to 4 million. 4 million shares. And you're done. So once you have this, substitute in the formula and get your diluted EPS. So diluted EPS will be equal to, now start substituting. Diluted EPS is shillings. What do you get, colleagues? Is it once? I have 179.4. Colleagues, you try to add and see.
Oh, why am I getting 199.4? Let me do again.
I have 19.39, like this, eh?
Yes,
Is it what you
the-
have?
all of you?
I also have 199.4.
Okay, perfect. So we can, that is our diluted EPS. If you want to compare, diluted EPS with your basic EPS now, because here you are advising, you are advising. So you can advise based on diluted EPS and basic EPS and see the movement. So if you want to get basic EPS, basically, originally for the basic EPS is always your part divided by the existing before you convert, before you change your debt to equity, what was your EPS? That's what we are trying to get. Existing shares. So our profit after tax, we had the 308 million. Then we divide by the existing shares, which is 12.5. 12.5 million. And the EPS here is what? Shillings. Before converting debt into equity, the EPS was at shillings. How much? Is it 246? 246.4. That's what I have. So you can now observe. Initially, this was your EPS. If you convert debt into equity, this will be your EPS. So it means that actually your earnings per share is going to reduce. If you convert your debt into equity. Okay, so that's how you will always handle any option that talks about converting debt into equity. That's how you handle. There is nothing that is going to change. Every time you're handling a question that talks about, let's say, converting term loan into equity, converting debenture into equity, converting, let's say, bond into equity, these are the steps you will only do following the formula. Any question? Because we are done with this option. We are done with this option, unless if there is any other question. So the option two is talking about share option, stock warrant. You're giving shareholders, you're giving shareholders a right to buy. You're giving a right to buy these. So at a lower price. These share options are issued at a price lower than the market price. And in such scenario, you will realize that it's actually like these shareholders are receiving free shares. And with share options, it is actually very, very easy. Because what you need is your diluted EPS, but this time on your numerator you will not be having this net interest saved, because here you are not, there is no interest you're saving here. You don't pay interest on what? On these shares. So this will be the formula, but here also the shares on conversion, These will be like what we call free shares. These are free shares. So when you're dealing with share option, that is the formula you need. That is the formula you need. So it means that we have everything, but we don't have free shares. And I recall last time giving you the easiest way you can get free shares. To get free shares, you simply get your discount. If you want to use the shortcut in the next zone, discount, then divide by the market price. Then times if you're converting, of course, they will give you the basis. Time the total options, how many total share option. That is the easiest method. Okay. So how do you get discount? But discount, you look at the market price. The market price is always high. Market price, then subtract the exercise price. These shareholders are going to exercise at how much? You're selling or you're converting these shares at how much? That is exercise price. So basing on our question, what is the market price?
It's 2,000.
The market price, let's see. The market price at exercise date is likely to be 2,000. Okay. Then at how much are you offering these shares? For you, you're offering these shares at what? At 1,002? At 1,250. So you see that there is actually discount. So you get 2,000, then subtract 1,250. And how much do you get? Shillings?
750.
750. Perfect. So substitute in the formula to get the free shares.
Which ones are the total share options?
So here, this is 750. And then the market price is how much?
2,000.
2,000. Then how many share options? How many?
That was my question.
Let me see. They must give you this.
Is it 1/6?
The company issues 1.6 million debenture stocks, where each debenture has one warrant. This is your share option, this one. This one is your share. These are the ones you're converting. So here you multiply by 1.6. 1.2. And what do you get? What do we get, colleagues?
$600,000.
600,000. I believe this is the easiest method, but if you want for you to take time, then we are going to say another method. Or you need to first know if you convert how much would you receive if you convert these warrants? Amount from warrant, of the proceeds from warrant, if you're to convert. Remember, you're converting 1,000, rather 1.6 million warrants. These are warrants options. Then you multiply by, you're converting at how much, or you're selling at how much. The exercise price is 1,250. How much do you get here? I think you get 2,000 million. Is it? Now, once you know this, then you ask yourself, at a full market price, at a full market price, how much, at a full market price, how many shares would you have actually received? At a full market price, you get what is number of shares. You get this figure, the amount from warrants, then divide by the market price, which is 2,000. So you would have received 1 million. Is it 1 million? Yeah, you would have received one. Is it 100? You first. 1 million. 1 million. You would have received 1 million shares. But you offered how many? You offered how many shares? But offered 1,600,000. These are the shares that were offered. So it means that ideally there are some free shares these shareholders are going to receive. This is what you could receive at a market price. But for you, the shares you're offering, in actual sense, we are saying you could have offered 1 million shares. But for you as a company, you offered 1.6 million shares to the shareholders. So it means that ideally they are receiving some free shares. The balance is your free share. So free shares is equal to 1.6 million, then subtract 1 million. You still get 600,000. But this one takes time. This takes a lot of time. So it's up to you in an exam to know which method you're going to use. But all methods give you the same answer. Any question about share option? Because once you have free shares, then substitute in the formula and get your diluted EPS. So this one, what will be our diluted EPS? Substitute. So our diluted EPS is equal to our profit after tax. We calculated 3. We have 3,080. This is in million. Then over existing shares, how many existing shares? What was our existing shares? 12.5. The existing shares are 12.5. 12.5. Then we add our free shares, which is 600. What do you get as your diluted EPS? This will be shillings. How much? If you use your calculator very well. Do you get 234, 235? 235.1 per share. But first confirm.
Yes, that's what we have.
Perfect. So that's all about that question. So remember, your basic EPS is this one. And now you're getting your diluted EPS as this one. So you needed to know how to advise. But every time you see a question, every time you see a part talking about share option, this is what you say. This is what you should think about. The formula would be this to get your diluted EPS. Then every time you see that you're converting a debt into equity, this should be your formula. Okay, so that's all about this question. But you are supposed to prepare a memo. Of course, a memo, you just, like as I said, to, from, a date, subject, and then introduction, then start now. Of course, these are workings which should appear in our appendix, maybe on the next page. Just the first page, we need to put the diluted EPS with basic EPS and advise. Then the workings, the next page. Because the impact, actually you're looking at the impact, you're looking at the basic EPS and what you have received, what you have calculated as your diluted EPS, and see the movement. Will the EPS decrease or increase? That is the impact. The impact on your EPS. So that's all about question 2. So we can go to the next question.
Before you go to the next question, how do you advise, like for this example, the basic EPS and the diluted EPS? How do you advise?
Of
What
course,
we are doing
here.
is compare
Sama, you can
EPS
go
with
ahead.
I remember he was saying that you say that you compare the diluted with the basic.
Yes, yes.
Then we follow the movement and we advise.
You see the first option. Of course, you are going to be talking about the option. The first option. Now you will see that the EPS initially the EPS was actually this. But if the company converts, that is first option. If the company convert the debt into equity, this EPS is going to reduce to this. Are we together? That is the impact. Your EPS is reducing. Even here, the EPS is going to reduce from this one, from 246 to this. But the question is, at the end, you need to know which one is the best option. Okay, this one, the EPS has reduced to this, the second option. Then the first option, the EPS has reduced to this. So what is the best? What is the best option? Yes, all options are reducing the initial initial EPS, but which one is the best? Which one is the best? Of course, you always need the EPS to be higher. That is ideally the earnings per share. It should always be higher. So between this option 1 and option 2, which one is the best? So to me, in an exam, I would first write about option 1, EPS has reduced from, I write this from this to this. Then option 2, the EPS has reduced from, I write this to this. However, I would advise maybe the company to go with option, which one is the best option?
Option 2.
Which one is the best option? At least you see that however much EPS has reduced from this to this, but at least this one is better than the first option. Are we together?
Yes.
Okay. So we go to the next question. This is question 3. If you understand question 3, you see, even because what we have handled on question 2, we are going to again repeat some things. But question 2 has different options. Okay. This is a standard, also standard question. Question 2 number. We are told Do Limited, a listed company, has provided, this is income statement. You have additional information. Please look at your profit statement of profit or loss. You have profit before tax. You have also profit after tax. Remember, if you have profit after tax, you can decide to pay dividend. You have dividend paid to irredeemable preference. This is whenever you're computing EPS and you can actually trace dividend paid to irredeemable preference to preference shareholders, please we subtract that dividend from the part. Even here you have dividend paid to ordinary shareholding. If it is ordinary shareholding, we don't subtract. If it is profit paid to NCI, we subtract. But here we don't have NCI, unless if it is given in additional information. But now here we have two things to note. We have dividend paid to. We have dividend paid to these guys, to the preference shareholders. Okay, additional information. On 1st, dates matters a lot. On 1st January 2023, colleagues, are you in a position to hear me? Samantha, are you saying something? I'm not getting you clear.
Can you not hear me?
Yes. Pardon?
I was not hearing you, but I can hear you now.
Okay, sorry about that. I'm saying on 1st January 2023, the issued share capital of Do Limited comprised of 48,000 ordinary shares. These are X shares, but each share is at this. This is par value. Okay, at a 20% irredeemable preference shares worth worth 3,000 million. So this is the amount of preference share. Okay. And now at this point, if you find that in the question they didn't give you dividend paid to irredeemable preference shares, you can get preference dividend based on this statement. Because if you want to get the dividend, you get the percentage, 20% times the amount, which will give you 600 million. Okay. Duru Limited had challenges in raising additional funds to meet the industry capitalization requirements and expand its operations, as management was concerned that raising additional capital could adversely affect its earnings per share. As a result, Duru it could face disciplinary action by the regulatory body. Okay. On 1st January 2023, management proposed the following options to the board as possible sources of additional funding for the company. So we have 4 options, and the required part they are telling us we calculate for the year ending 31st December 2023. Duru Limited is projected earnings per share, that is basic earnings per share, and diluted earnings per share where applicable. So it means that you need to know, is this option going to help you to get basic earnings per share, or this option is going to help you to get diluted earnings per share? So in respect of each option. Okay. So we can handle option by option. Option 1, they are telling us the company issues 1 share for every 8 on 1st May 2023 at a full market value. That is option 1. So we can start with option 1, where you have issued your shares. You have issued your shares at a full market price, not at a discount. Here it is at a full market price. There is no discount. So if you issue your shares at a full market price, what will be the impact? Issue of shares at a full market price. Okay. Now recall, every time you issue shares at a full market price, basically what you will be getting is basic earnings. You will be getting basic earnings per share at a full market price. What will be your basic earnings per share? Of course, the shares are going to increase. You get the existing shares plus the number of shares. That is like you will be getting what we call once. So it will be this formula. Where is it? We had somewhere. Okay. Yeah. Then here I add just new shares. Oh, here you add simply say once divided by once. That is weighted average number of shares, which is existing shares plus new shares. But we needed to know, how do we get this once? Because last time I also talked about a scenario how is your one-off, what are the things that can affect your one-off? That is if you issue shares on a cash basis at the market price, among others. You maybe if you exchange shares, that is the theory you need to read. But how do we get are we given part direct? I think this one's part we are given part direct, we are given preference dividend. Profit to NCI is 0. So how are we going to get our one-offs? I can make a table. Okay. We are going to see in a scenario where you issue bonus shares. You will create a column for bonus fraction. If you issue rights issue, you will create a column for rights issue bonus fraction. But if you issue shares at a full market price, you don't create those columns. You just need only this. Then, before issuing new shares, before issuing these shares at a full market price, how many shares were existing? So you started the year, that is 1st January 2020. We are dealing with which year? 2023. You started this year with how many shares? So we go to our question. We started this year when the company had an issue. In issue, how many shares? 48. Are you seeing that? So we had 48,000. 40. Here is 48,000. Next, these are going to exist for how many? Before issuing, you issue the other new shares. Next is new shares. New shares. You issued how many new shares? Basing on our question. They are telling you issue 1 share for every what? Colleagues, let me hope you are listening because you are quiet. We are issuing 1 share. Issuing. It's 1 out of 8 times existing shares.
Times 48.
So new shares, you just get 1 out of 8 times 48. Those will be your new shares, which is 6,000, I think, isn't it? You get 6,000. 1 divided by 8 times 48. Yeah, these are my new shares. But these ones are going to, in our way of income or in this financial year, these shares are going to come on which date? Is it 1st May? 1st May. When did you issue these shares? 1st May 2020, 2023. So we are going to ask ourselves, these 48,000 shares, before issuing new shares, these shares existed for how many months? From 1st January to 30th April. I think those are 4 months. 4 out of 4 out of 12. Then I would prefer we deal with totals. Get this plus this. Here you get 54. Here we get 54. Now, from 1st May to 31st December, you will be having in total how many shares? You will be having in total these shares. So these shares from 1st May to these shares are going to exist for how many months? From 1st May to 31st December, how many months? 8. 8 out of 8 out of 12. 8. So if you get this time this, what do you get? I have 16. Then if you get 54 times 8 out of 12, what do you get? Do you have 36? 54 times 8 out of 12, I have 36. Please, in case there is a question you ask, so get this plus this. This will be your total one-offs. Your one-offs is 52 shares. Okay, let's see what I have. Are we all okay here?
Yes.
Perfect. So next is to substitute in our formula. Since we have everything, substitute in your formula and get the EPS. What is your profit? What is your profit after tax? Basing on our question. Profit after tax.
25,500.
It is this. Then next.
Then we less the preference dividends of 600,000.
This is 2058. 500,000. Minus what is our preference dividend?
600.
600,000 minus profit to NCI is 0. We don't have that. So divided by your one-offs, which is 52. What do you get? Shillings.
1,406,500.
Pardon?
1,406,500.
1,4. Let me first see. 2058,500 minus 600 divided by 50.
I think I didn't add the 3 zeros on the 2058.
2058,500.
Even the 600, the 600 million.
This is 600 million, eh? That's what I have. First confirm. That's what I have.
That's what I have.
28,048.
Okay, perfect. So that's our option one.
Excuse me.
Yes, please.
Excuse me. One is only 52,000. It's not 52 million.
Pardon?
These ones are not in thousands, the shares. One is only 52,000.
This one.
It's not in millions. Mm.
It's not in millions. Let me
Shares.
see in the question. Basing on our
It's okay.
question,
I think they are not in millions.
shares are not in millions. Yeah?
Okay.
It is just 48 ordinary shares, 48,000 ordinary shares. All right. So that is our option one. We are done with option one, and we have the answer as our basic earnings per share. So colleagues, every time you see they are telling you that the company issued shares at a full market price, think about this. Think about this. Think about the effect on. The effect will be just on you to get once. Then option two. Option two. Option two. What are they issuing? Share option. This is what we handled. Every time you see share options, it means that you're issuing some free shares to the existing shareholders. Share options. Share option is like a warrant. You're issuing some free shares. It's like you're issuing at a discount. So it means that before even I analyze, the moment I see each of share options, I will recall that there must be market price, there must be exercise. There must be exercise what? Exercise price. Yeah. And the steps will remain the same. Share options. Share options, what you need is this formula. Where is it? Where is our formula for share? So if you see that you are dealing with share options, it means that this time you need diluted EPS, because you will have a decrease in that EPS. Let me see. The formula was, it is here. Same steps. See, once you understand this casting, it is this standard, it is not all that complicated. So we have everything. So we can handle this. We can handle this. Do we have existing shares, first of all? Because we have this, we have
Yes,
this.
they have 48.
Existing shares are 48.
Yes.
So just you just need free shares. And how do you get free shares? The formula is the same.
Use the other formula of discount over.
This one is the one which is easier, eh?
Yes.
Okay, let's use the first formula. So what is our market price basing on the question? Let's go back to the question and see. A share option to senior members of staff during the year with an option to purchase 10,000 ordinary shares. So these are your share options at a shillings 12,500. This is exercise price, provided they all remain with a company for the next 5 years. So that is where actually, that's where the difference is. With rights issue, you don't wait. With rights issue, actually, you immediately see the impact. But here you have the impact will happen in the future. But you need to start recognizing from the time you are saying that, okay, if you stay in this company for next 5 years, you will qualify for what? You will qualify for some discount. you'll qualify to buy some shares at a lower price. This is different from rights issue. Rights issue, you state that day and the shareholders exercise the right. But share option, these shareholders don't immediately exercise their rights. They have to first wait for the condition to be satisfied. That's why you will see that rights issue affects basic earning, but share option do not affect basic earnings. However, all of them, the company is issuing these shares at a discount. The reason why rights issue will affect basic earning is because you're receiving, as a company, you're immediately receiving cash. You're receiving immediately the money. So, but here you're just waiting for a certain period of time. Okay. So what is our market price? The average share price during the year was projected to be this. So this is our market price.
800.
4.2. So you see how the number is becoming sweet. 12,800 minus the exercise price. 12,000. 12,000 what? 12,000 what? I don't recall. 12,500. Okay. 12,500. So the discount is of only
The difference is 300.
300. So what is your free share? So the discount, we have confirmed that the discount is 300. Then divided by the market price, which is 12,800 times share options. They are going to exercise how many? 10, eh?
10,000.
10,000 shares. So what do you get as free shares?
I'm getting 234.37.
What about others? I am getting a 2.3 for shares. Eh? Let me hope also others are getting this. Okay, that's your free shares. Substitute in the formula and get the answer. So here you are getting diluted EPS. Here you are diluted EPS will be equal to, here you get existing shares, which is 48,000 plus free shares, which is 234. Finally, what will be your diluted EPS? Do you have this 30,238 share? You can confirm.
Yes, that's what I have.
That's what you have, eh? So that is option 2. We got option 3. Option 3. Option 3 is about what? Option 3, it's about rights issue. I think we have not yet handled a question about rights issue. So this is your rights issue. Okay. You realize that when you're issuing rights issue, also you are issuing at a lower price. But only the impact is, or the difference is here, you're receiving immediately the cash. You're receiving the money immediately. Not like share option where you have to wait after a certain period of time. And also another thing is that rights issue is made to existing shareholders. This one. Rights issue mostly is made to the existing shareholder. And share options are actually given to employees. Share options mostly are given to employees. You have been there as a worker. If you work for a company for more than 5 years, you qualify, depending on the policy of the company. But rights issue basically to the existing shareholders. And here you realize sometimes we apply IAS2, IFRS 2. That is, share options does not guarantee, does not generate cash immediately, because they can ask you the difference between share option and the rights issue. You just need to know such kind of things. So here with rights issue, we are going to be looking for basic earnings, basic EPS. Share option, you're looking for diluted EPS. Rights issue, basic earnings. So it is, you divide by here, you divide by 1/OS. Because every time you're talking about basic earnings here, it's 1/OS. But how do you get 1/OS when you have issued these ones, rights issue? This is not at a full market price. So I can again draft the table marker because I need 1/OS. Where was our first table? Before here. With rights issue colleagues, we need to master it once and for all. We don't need a challenge next time. Every time you issue this, you need to think about what we call TAP. We have heard about this word. Okay, you need rights issue bonus fraction, which will be equal to the actual CAM rights issue, actual CAM rights issue, which is always actually the market price. This is like the market price at the time you are issuing rights issue. What is the market price? Then divide by TAP. Do you know the info? TAP.
Theoretical X rights price.
Yeah, that one. Theoretical X right price. Theoretical. This is theoretical TAP. Stands for theoretical X price. Theoretical X what is it? Is it theoretical X right?
X rights. rights price.
X right price, like this.
Mm.
Okay, so how do you get this actual CAM rights issue is like your market price, but how do you get this tab? We can use this table. But I first delete some things. Okay, so what I will do is put here date. I don't need here date. Date doesn't or that. Or if you can put details, number of shares, then here put number of shares. We don't need the time when we are looking for part. I need you understand this. Then other things will be simple. This is price per share. Price per share. Then this is you can call this market capitalization. Market capitalization. We have another method, but the table looks to my side it looks easier. So what we are going to do, even this first column is not all that necessary. You just need this. So here you need to know what were your existing shares. Okay. Then during you can put here during rights issue. During rights issue. Okay. Then we can have another last row for what? Another last row for after rights issue. After rights issue. Okay. Existing shares. Now we go back to the question. They are telling us that make rights issue of ordinary shares on not the date in the proportion of 1 for every what? 1 for every 5 held. So it means that initially you had 5 shares. 1 for every 5. So it means that you're holding 5. Okay. Then during rights issue, you are issuing how many? 1. So when you add, you will get what? After rights issue, get this plus this. So this will be what? This will be 6. Okay. Then here, existing this is at what price?
The first one is at 12,800.
This one you use the current price. Okay. You use the current price. Then, then here, during rights issue, what is the price?
12,400.
The price is this one. Okay, so 400. Okay, then if you multiply 5 times, because here you don't have the price, that will be your tap actually. This will be our tap, the price here. This will be our theoretical X rights price. So if you get this time this, what do you get?
64.
64, eh? Then next.
12,400.
Next is 12,400. If you get this plus this, what do you get as your total?
76,400.
76,400. So how can we get our tap?
Divide by 6.
We divide by 6. Tap will be equal to 76,400 divided by 6, which will be
12.7.
which is 12.7. Like this. That is my tap. So what is your rights issue bonus fraction? Since you have the tap, what is your rights issue bonus fraction? It will be equal to your market price. Remember, actual CAM rights issue is your market price. And the market price,
That is 12,800.
that is 12,800. 12,800.
12,800 over 12,700.
Over our tap, which is 12,700. That is our bonus, our rights issue bonus fraction. Perfect. So we can now draft a table again because we need one was. So once I have this, I can do like this. Then I put here date, details, number of shares, time. Then I introduce another column for rights issue bonus fraction. Okay. Perfect. So remember, you need to be asking yourself, what are the shares that will qualify for rights issue bonus fraction? Those are the shares that existed before issuing rights issue. Before rights issue. Any shares that existed before rights issue will qualify for the bonus. So these are our existing shares basing on our question. Basing on our question, existing shares are 48. Yes, please.
For all the questions we have been having the existing shares. Is there a question that has ever come without existing shares?
Yes, if you find that you don't have existing shares, then they can give you part and they give you they can give you part and they give you basic earnings per share. Then you say from basic earnings per share is equal to part of a number of existing shares you can get. existing shares. So if they don't give you existing shares, know that either they have given you basic EPS, whereby basic EPS is equal to profit after tax divided by number of existing shares. And also, you may meet a scenario where you are given 2 years. Let's say 2020, 2022 and 2023. The existing shares should be those ones that existed when you closed the last year, because those are the shares you start with. You don't use the existing shares as at the current date, because they can give you balance sheet, whereby that balance sheet has 2 years. They have shares for the 2023. They have shares for 2022. For you as you pick shares for the previous year, because those are the shares that actually that the company had at the start of the year. Let me hope I have responded to your issue.
Pardon, on the other formula that you said when they've given us basic.
From EPS. Basically, when you're getting EPS, earnings per share, it is your profit after tax divided by number of shares, which are existing shares.
So it's substituted to EPS. Given us EPS, we substitute to EPS, and we find the existing shares.
Yes.
Okay.
Okay, so we are here. So we are going to ask ourselves, these existing shares existed for how many months before rights issue? These existing, remember we are handling next option. Don't think that we are still handling option 2. No, we are done with option 2. We are on option 3. So for you in your mind, you need to know that you have 48,000 shares as existing shares. Then from 1st January up to the next period, you are issuing this rights issue. Which date? You are issuing rights issue on 1st November. So it means that the existing shares existed for how many? These ones existed for 10 months. And because these existed before rights issue, they will qualify for rights issue bonus what? Bonus fraction. These shares that existed before rights issue qualify for bonus fraction. And what is our bonus fraction? It's this one. This is our bonus fraction. And you can also, if you divide, what do you get? This is this is 1.005. Okay, now I can use that as my okay. So what is your ONOS? Get this number of shares times time times weight times the bonus fraction times ONOS. Hey, no. It is number of shares times time times bonus fraction, then you get ONOS. What do you get? 40 to 100. First confirm. That's what you have. Then next date, we have 1st November 2023. The company issued what we call rights issue. You have rights issue on new shares. How many? How many now in total? It is one for every what? One for every 5.
And
So get 1 out of 5 times existing shares. What do you get?
9,600.
9,600. So what is our total?
5,7,600.
5,7,600. That is our total. So these shares are going to exist for how many months before the end of 31st December 2023?
2
These
months.
only 2. It is 2 out of 12.
Oh,
But these ones will not qualify for a bonus fraction, for the bonus. This one they will not qualify. So here it is not applicable. The rights issue is not applicable. Please take note, bonus fraction, rights issue bonus fraction, they only affect the cumulative shares that were existing before issuing those new shares. So if you get 57,600 times 2 out of 12, what do you get?
9,600.
9,600. So what is your one-off if you add?
49,800.
49,800. So this is our one-off. And that's all. Simply substitute in the formula and get your basic. I can bring this. So this will be over 49,800. What do you get? You get shillings 29287. That's what I have per share. That's what you have, or it is different?
What I have.
Okay, then last option. Colleagues, that's how we handle rights issue. So it means that with rights issue, the first step is to get bonus, rights issue bonus fraction. Okay. Once you get rights issue bonus fraction, then go ahead and get one-off. Once you get one-off, substitute in the basic earnings per share formula. So last option 4. Option 4, it is talking about what? Issue shillings 100 million, 10% convertible and secured bonds at the end of the bonds are convertible into, are you seeing this? You're converting a debt into what? Equity. Think about net interest saved. Think about notion shares. That is shares on conversion. Those are the only 2 things you need. But the fact that here you have different years, you should test for each year. But the fact that if you realize that you have a constant, because this implies that in 2024, you can offer at this amount of money. This you can offer at this amount of money. Here you can offer at this amount of. Sometimes you find that the price is different. You may find that the price is different. So you have to test for each option. But if you confirm that these these prices are constant, these ones. You're offering you're offering these shares at a different price. Then you test for each year and take the higher. But here we'll need to see where can a company generate much revenue? Where can a company generate much revenue? Anyway, let me first write something here. This is the convertible bond. This is like the one we handled about debenture. Here you will be looking for here first step. If you have different years, simply determine the highest, the one that can give you the highest dilution. The highest dilution. The highest dilution possible is basically that one that results in the highest number of shares. Here you are talking about the one with the highest number of shares, but it is not all that. Not all that. It's not all that direct. So for you in a do, we are going to say if you convert. Okay, the formula is that we have that formula here. Already we have that formula for bond, for debenture. It is here. This is basically the formula we need. Okay, this is the formula that we need. So simply what we need is the net interest saved, then shares on conversion. Now you would look for net interest saved and shares on conversion for every year, But the fact that now here the amount is constant. Okay, let me first say what. Let me first talk about. In 2020, which year are we in? Which year? The first year is what? In okay, let me say, if let's say you convert, if converted, if you converted, let's say, if you converted in 20, what was our first year? If you converted this bond into equity in 2024, what would be the number of shares if you converted 2024? Remember, they are telling us here, that 60 shares for shillings this. For shillings 1 million. 60 shares for shillings 1 million. So it means that with 1 million, with shillings 1 million, you can get what? 60 shares. Okay. With 1 million, you can get 60 shares. Now, what about when you have shillings? Basing on the question. What about when you have this issue shillings this? When you have 10 million shillings, 10 million, how many shares would you actually get? Shillings 10 million. This one can give you how many shares? You do cross multiply and tell me. You get 10 million, or rather 100 times 60 divided by 1 million. You get what? You get 6,000 shares. That would be the first year. Then you keep on doing the same for each year. If converted, in it
I thought you just should choose one with the highest share.
2025
Abel,
constant, this price is constant. Are you saying that?
Abel, I thought in that case we just choose the year with the highest shares, like
That is
2026.
Yeah, that is true. Me, I'm trying to explain. In a scenario where the price here, you see here you have 1 million. You have 1 million. You have 1 million. But sometimes you may meet a questioning that the figure is not what? Is not the same.
Oh.
So if the figure here is not the same for each year, you have to first know. You have to first calculate for each year and see with shillings 1 million, where are you going to get the highest number of shares? Are we together? So you keep on testing based on the price you have. You keep on saying, okay, this is one with 1 million in 2020, in 2025, the price is shillings 1 million, I get 70. You also now here if they say 2 million, then you start with that 2 million. Here you could say shillings 2 million. If they put here, there are 2 million. If shillings 2 million would give you 70 shares. What about now what is an issue? Shillings 100 million. So you keep on testing to see where you have 1 million, which year gives you the highest, and that's where you are going to base when you're determining the net interest saved, when you're determining the shares on conversion. You base on this one. When you test at the end where you see that shillings 1 million is giving the highest number of shares, that is the year you will focus on. But this question is direct. Is direct for you. What you will just do is to choose the year with the highest number of shares, because you realize that is the year that will give you the highest number of shares. So here the highest number of shares is in 2026. So we are going to rely on this. So here, if 1 million is giving you 80, what about shillings? What about shillings 100 million? So here you are getting what?
8,000 shares.
8,000. And these are your new shares. So this is another way you can get the notion. This is another way you can get the notion. The notion shares. Remember all the shares on conversion. Now it means that we have the shares on conversion, which is 8,000. Remember the first method. The first method we had to do something here. Where was our? It was which option? Where we calculated the convertible. It was here. First, go to know the total amount of debenture. Total. Okay, you first. Is this the question? Here we were getting. This is another method we were using to get new Notion shares. First, know the number of debentures, like that. But here, this is another way you can actually determine. This is another way you can determine the shares on conversion. You just say, you know the amount at shillings 100 million, you can get 80 shares. What about shillings 100? You will get this. So it means that in our formula, we are left with net interest saved. We are left with net interest. How can you get net interest saved? Which is also easy. First, know the interest you're supposed to pay. Okay. Basing on this question, the debt, the bond was at this interest rate, and this is the amount. This is not the number of. This is not the number of bonds. This is the amount. So you get 10% times. So the easiest way also to get net interest saved, you get the interest rate times the amount of bond or the debt, which is what? 100 million. Okay. Then times 70%. That is another way you can get direct net interest saved. Instead of first getting, without this 70%, you're getting net interest. Then after that, you raise what? You raise the tax. You raise the tax benefit of 30%. 30% times this would be not interest. This would be your interest saved, not in. This would not be the net interest. If you do like this, net interest saved is equal to this. What do you get? 10% times 100. Is it what 10% times 100? You get 10 million. Okay. Then tax benefit is 30% of 10 million, which is 3 million. So it means that the net interest saved will be equal to the balance, the difference. Which is 7 million. But this one takes time. Or shortcuts like us. In an exam, we don't have time. Net interest saved is equal to, I just know the rate, I multiply by the amount of money, then times 70%. Times 70%. I believe you get 7 million. You get 7 million? So that's also another shortcut to get net interest saved. And once you have your net interest saved, substitute in the formula and get diluted EPS. So my diluted EPS, what was our profit before tax? It is still this. I think
Yes.
here it is 2058.5 million. Then we add net interest. We subtract our preference dividend of 600, which is 0.6 million, minus the interest saved, net interest saved of 7 million. Okay, divided by what is our existing shares? 48. Existing shares 48,000 plus shares on conversion. Shares on conversion, if you convert, you get 8,000.
But why are you changing the formula?
Why am I choosing?
Why are you changing the formula? Aren't we supposed to add in the interest saved on the...
Yes. Thank you about that. Here we are supposed to add. Because the formula is this one. You are adding net interest saved. Here it is a plus. So finally, the answer is what? The answer is shillings 26170 per share.
It is also not 0.6, it is 600 million. Not so.
600 million, eh?
As if.
Okay. So the answer, do you get this?
Two six one six nine.
Pardon?
Yes. Yes, it's that 26169.
26169. If you round off to a whole number, you get this, eh?
Yes.
Okay. So basically, that's how you would handle for each option. But I repeat, colleagues, in a situation where you have a different amount here, you handle each one by one. Handle one by one, following this rule. This one. So this one is in the 2020 what? Where we have the highest shares. 2026? Yes. But in a situation where you have different amounts, please test for each year until you get where you have here the highest, number of shares. It's the one you will use on shares on conversion. That's what you put. Here we put the one with the highest. We put the highest number of shares. Any other question? Because we are done. Just that this question may be for comparison. You could first know, okay, before all these options, what was the EPS? Before all these options, what was the EPS of the company? What was the basic EPS of the company? This is where we should start from sometimes, or you can bring it at the end. The EPS of the company is always just this divided by the existing shares. That would be your EPS. And the part you use here is the part for the previous year. If you have the previous year, that is the one you would use. But this question, it just required us to just calculate for each option, not advise. So even this one is not necessary. We are supposed to simply calculate. Calculate for the calculate the projected earnings per share and diluted where applicable in respect of each option. And we have done that. So that's all about this question. Question 4, we'll handle it next time. Question 4 and question 5.